we saw this downward cycle of the mortgage bonds, and then the inflation hit. We saw this really trajectory downward, and then we saw this blip upward. So if you can see this line right here, this right here is the 25-day moving average. Anytime we see a big separation from this, from the downward trajectory from this, there's a term called the leash effect, and it has a tendency of pulling the bonds back in. So that's what we're kind of seeing right here. The economy, because we're not as strong and the stock market's really bleeding right now. A lot of times people take money out of stock market, they invest in bonds. So we're seeing a little bit more of a reinvestment here. And so that's really helping us bounce upward. So it was a pretty dramatic drop here. And now we're kind of on the upward mend. So that's a good thing for mortgage bonds. That's a good thing for mortgage rates. This week is going to be a very important week. I'm going to get into the calendar real fast, but we want to break through this Fibonacci level right here. If the mortgage bonds can break through here, we'll see a big swing of about 100 basis points in pricing for the better if we can break through here, which is equivalent to about a quarter better in rate. So if we can break through here, we may improve by about a quarter better in rate this week. It all depends on what the Feds are talking about. If the Feds continue to go about their plan for raising interest rates, which they say in March, they're going to do the first rate hike. Today, they're going to explain what they're going to be doing. They're kind of stuck between a rock and a hard place because the markets are not as strong as they thought. We've really been fed with nitrous for the last 2 years with all of this money that's been injected into our market through COVID, through everything. I mean, there's been trillions of dollars spent to bolster our economy back up. Because that's slowing down, it's going to show the true colors of our economy. And that is a little bit scary when you have the talks of raising interest rates, because if you raise interest rates on the Fed level at the Fed window when the markets aren't as good, it could be a bad choice. So this week's speech by the Fed is going to be very important to see which lever they're going to be pulling. Are they going to be continuing with the raising of the interest rates, or will they be running off their balance sheet and selling off their balance sheet to control inflation? So if they raise the interest rates on the Fed window, on the prime rate, that will actually help interest rates on mortgages because it'll offset inflation. So anything they do to offset inflation, we should have a good impact on mortgage rates. So keep your fingers crossed that they don't screw this up for the mortgage side of things. And overseas, China and a lot of the other countries that are very big in the GDP of the global GDP are really begging us not to raise interest rates because they've already come out and said that other countries are not raising their interest rates globally. So we would be one of the only ones that's doing so. It'll make the dollar strong by doing that, but it'll kind of mess up our trade for other countries as well. So it's a very delicate place that the Feds are in right now. So we're going to really watch that carefully. Here's the little economic calendar, what's happening today. This kind of shows what exactly is happening. We have a 2-year treasury. Now on the 2-year, the 10-year and the 2-year are getting very close together in their yields. If they come and they become flat or inverted, that is a sign of a recession. So we're going to watch that carefully as well. But the FHFA home price index is going to be coming out. The consumer confidence is going to be coming out on Tuesday. The treasury auctions are going to be happening. Inflation numbers are going to be coming out. The GDP is going to be coming out this week. And then obviously the Fed speaking is going to be interesting. So this is going to be an action-packed week. Continuing jobless claims are coming out. And Friday's the big number for inflation, and they're expecting it in the high 5s on the core inflation level. So we'll see what happens there. Here's a little snapshot of where interest rates are nationally right now. 30-year fixed, the average is 3.67 with a cost of 0.40 points. It's a lot different than where we were a year ago. So we're about 0.75% higher than what we were about 3-4 months ago. So definitely an impact, definitely impacting your borrowers or your buyers as far as how much they can afford. So now we're going to get into any questions first off on what's happening with rates right now. Don't be shy. All right, I don't see.
Sean, why is the 5/1 ARM so expensive? I thought usually that was a really good deal.
Yeah, the short-term interest rates are going to be taking a beating because of the yield curve is very similar. So there's not much benefit in the short-term versus long-term money, and that's where that 10-year and the 2-year are almost the same now. That's called once you get opposite, it's called an inverted yield curve, and yeah, it isn't very attractive. And when interest rates are this low, though, it's hard for anyone to make money if you're going to go less than 3% on a mortgage. If you're going into the 1s and 2s, you're really doing it. It's a free loan basically. So those yields have to stay a little higher. It's just they're kind of flattening out, and that's that yield flattening I was talking about. So, but good question. So I'm going to get into our topic of today was how does today's market differ? How does it differ from 2007? So I went through 2007. Probably a lot of you that are on this call have been through 2007. So I'm going to share with you. Hold on one second. Let's see, that's screen number 2. So how does today's housing market resemble 2006? And does it resemble? Can you guys see that now? Joyce, I see you nodding. Okay, perfect. So first off, I want to make it very, very clear that supply and demand is one of the main factors in the difference between our markets. And they are very, very different markets. So if you hear that people are saying it's a bubble, we're going to really analyze this to see, well, is it really a bubble? Is it? Let's find out. So here's the appreciation. I want to show you this real fast. This is really remarkable. And as you know, the supply and demand factor just keeps getting tighter and tighter. Now, this is the appreciation from June of 2020. And if you notice, it is a gradual acceleration of appreciation. We had 4.4, then 4.8, 5.8, 7, 8.5, 9.5, 10.5, 11.3, 12, 13.3, 14.8, 16.6. And then we ended right around the 22%. That's rapid appreciation, but it's accelerating. It's not a spike up and down. It's a constant gradual acceleration. And there's a lot of different factors for that, which we will get into. But let's get into the next screen here. This is the home prices based on interest rates. So when you look at the cost of real estate, there's a couple different factors that come in mind. First, there's the interest rates at that time. And then there's the income that people are getting at the time to see how much they could actually afford. So if you look back at 2006 at where the interest rates were at that time, they were close to 6%. They were over 6%. Prime was at 4.75. We had rates that were very, very high. Plus we had very, very high home prices for that time. Everyone thought it was overpriced, but rates were also very, very high. So if you look at the average, the 30-year history of the mortgage rates, we're at an all-time low. So when you accelerate the employment income that people are getting and you lower the cost of debt, that would create a surge in people buying homes. And that's what we've seen. Well, when you have a surge of buying homes and you have an inventory at all-time lows, between 2006 and 2010, there was it was a cliff at how many homes were being built. It dropped significantly. So when you see now the cost of money going way down, and as you'll see on the next screen, which I'll pull up here, the incomes spiking up from that time. So incomes are up 55%, rates are down half of that, and homes are about 44% higher in cost, in appreciation over that 14-year window. So if you see our incomes going up like this and the cost of money going down, the formula for actually having the houses being affordable, the affordability index plummets, and it makes it very cheap to buy homes. So when you have a formula like this, where the incomes are going up, the cost of money is going down, even with appreciation, we're still at a market that is very conducive for people to afford to buy homes. Look at this is a quick analysis here. How much more affordable today than 2006? So if you look, if you look at 2006 and you look at a $300,000 home at 6% rate, that's a monthly payment of $1,800. If the household income was $6,000 at that time, their mortgage is 30% of their income. Now switch that to right now with a 41% appreciation, 2021 at 423 with a rate in the threes, that's a 1783 payment. With the household income higher at 9,300, that mortgage is now only taking up 19% of their total income. So the affordability right now is better than back then. So when people are saying, I'm going to wait, it's just because we went through a what I call the spoiled zone. We were all very, very spoiled. We had rates low with home prices that were low, and that caused a buying spree. So 2020 to 2021, everyone was moving around the country. People could relocate and work remotely now, so they didn't have to work in the cities. So we saw massive appreciation and a massive flow of people coming into our markets. So that's one factor, right? Low rates. And now we have a problem with inventory. So because we have an inventory problem, there will always be a battle to get that house. Anytime there's a battle to get that house, you're going to bid up the price. It's just common, almost like an auction world, right? It's going to happen. So that's why we've seen this gradual increase in appreciation, and it's going to level off. It will level off. But is it a bubble? We have to also remember, and if you look at the graphs, and I don't have this graph, and I'm going to try to pull this up again, but if you look at the average household debt now versus back during the bubble, the average household debt was up 75% to where it is now nationally. It is a drastic drop in the overall household debt. We had more debt in 2006 and 2007 than we've ever had as far as a percentage of debt per income. It's a much better number right now. So people are hoarding their money. They're keeping their money, and they're not going into debt as much. Maybe everyone learned their lesson back then. So the fact that we have more money now is a positive thing. Also, we all know the types of mortgages that were being given during that time. I was in the mortgage industry then. They were just doing stupid loans. Like if you were a W-2 teacher, you could say you made $15,000 a month and get a mortgage. It didn't matter. It made no sense. They were liar's loans. They couldn't afford them, but homes were appreciating so quickly, they could get the mortgage, make it work for 3 months, sell it, and make $100,000 in appreciation. And that's what people were doing. They're buying investment properties over and over again, and they couldn't afford them. And then once those came due, because they were adjustable rate mortgages, they got stuck. All of those loan products are gone. So all of that is gone. That whole factor is one of the main parts of the mortgage crisis, because what happened was those lenders that made those, they lost their shorts because people were defaulting like crazy. And then there was no other mortgage for them that could bail them out, because now the whole mortgage industry changed to full doc, and all these people that lied on their loans, they couldn't refinance. So it became this domino effect. That whole part of this market is deleted. There's no such market anymore. We now have people that have mortgages that can qualify. They have very good income. Their affordability index, which we saw right here, is at an all-time low, and we have low inventory. So if anyone thinks this is a bubble, they are sadly mistaken. Now, will this market change? Absolutely. Here's what I think will happen. I think with rates ticking up, a lot of the market of the first-time home buyers will slow down for those that couldn't afford the properties, or they'll move to different markets. So we'll see a little bit of slowdown on that because of the raise of interest rates. The inventory, I think some investors will maybe say, you know what, it's time for me to sell our properties and capture those gains, especially with what's happening with the markets right now in the stock market. They may want to sell those, get their gains, and maybe buy at a low. So I think you'll see some investors now enter into the market and get a little bit more inventory, which will be a little bit more healthy, which will bring down the appreciation because there's more homes on the market, so there won't be as much bidding wars. So I think you're going to see this market continue to have appreciation, but it's going to slow down. Now, what's happening in the stock market is a different thing altogether. Hopefully, the Feds will control that, and they won't act too much where the stock market will continue to plummet. So we'll really gauge that carefully. But as far as the real estate and the demand in our market, it will continue to stay strong, and it is nowhere near the same market as 2006, mainly because the mortgages, and second off because of the affordability index, where interest rates are, and just the supply and demand. So here's some interesting numbers I jotted down as I was doing some research. The amount of homes that we had for sale, and this is for sale during 2007, we had 3.7 million homes on the market in 2006 and 7. 3.7 million. Right now, nationwide, we have 910,000 homes for sale. Now, keep in mind also, because of population growth, the amount of homeowners and those households that are looking to buy is up by 13 million people. So we have more people, a third of the homes, or actually a quarter of the homes that are on the market. How could there be a bubble? It's just not possible. So we have 12 to 13 million people trying to buy 3 million less homes than what was available in 2006. So again, it will slow down, but just the numbers, they don't add up to a bubble. Now, how to talk to your buyers about this, about waiting, is going to be difficult, because all they feel is the pain. Because if they went through that 2006, they know the pain that was associated with it. But we need to come to them with facts and with figures to really help them understand where we are in this market. It is drastically different. So we'll keep an eye on interest rates. We'll make sure that there's nothing crazy happening there. But as long as the Feds do their job to not sway one way or the other too drastically, then I think we're going to see rates actually come down a little bit towards the end of the year, with them hopefully getting a handle on inflation. And we should see a little bit more homes on the market for a flatter appreciation and a little bit more normalized of a market. So it's going to be just a supply and demand factor. So let's watch those number of homes on the market, and hopefully that will increase as we move forward. But this market is nowhere near the same as 2006. So I'm going to share all of this information with you guys as well. So you'll get that in an email afterwards. I'll send you the actual PowerPoint if you want it as well. And then the recording of this as well. So with that being said, I'm going to open this up to any questions that you guys may have. I'm sure you've